Hey friends, if you've ever been told you don't show enough income on your tax returns, or your DTI or debt to income is too high, even though the rental property cash flows, this video is going to be for you. This is Lance Hulsey, and today I'm breaking down DSCR loans, what they are, how lenders calculate the DSCR, what the typical requirements look like, what properties qualify, and how to apply and how to choose the right lender without getting burned. So what DSCR is the simple definition. DSCR stands for Debt Service Coverage Ratio. It's a number lenders use to answer one question. Does the rental property bring in enough money to cover the mortgage payment? It's that simple. It's basically a cash flow stress test. How DSCR is calculated is net operating income equals rent income minus operating expenses, things like taxes, insurance, maintenance, management, and so on. So the total debt service equals your loan payment minus typical principal plus interest. A DSCR of 1.0 means the property produces exactly enough to cover the payment. Above 1.0 means coverage has room to spare. Below 1.0 means it doesn't. Most DSCR lenders want a minimum somewhere around 1 to 1.25, depending on the lender, the property type, and the risk. So a quick example, let's say the property's NOI is $2,500 a month, and the monthly mortgage payment is $2,000. 2,500 divided by 2,000 is 1.25 DSCR. That usually is a strong number. How DSCR loans work? Traditional mortgages lean heavily on your personal income, your W-2s, your tax returns, your debt to income ratios. DSCR loans are primarily underwritten on the property's income and not your personal paycheck. So lenders still look at your credit, your assets and reserves, your down payment, the property type, and rentability. But they often don't require tax returns or W-2s the way conventional loans do, especially with investors who have complex write-offs. But here's the reality check. Because these loans are outside traditional guidelines, rates and fees are often higher than conventional investment mortgages. So, who are these DSCR loans right for? They are a great fit if you're buying or refinancing a cash flowing property. If you're self-employed, write off a lot, or have complex income. Or if you're trying to scale a portfolio without getting boxed in by the debt to income rules. So DSCR loans can be a poor fit if you're light on cash reserves, the property doesn't produce stable income, you're chasing the lowest possible rate like a conventional often wins there. So here's an honest list of the pros. Qualify based on property cash flow, not your personal income. That's a big pro. Often, less documentation is required than a traditional mortgage. So that's a big pro. It's helpful for investors scaling multiple properties. Now, some of the cons are higher rates and fees than conventional investment loans. Your approval and pricing hinge on the DSCR, which can change based on rent assumptions, vacancies, and expenses. And often a larger down payment and a bigger reserve requirement is needed. Sometimes prepayment penalties do apply, which can trap you if you plan to refinance soon. So check with your lender. Typical DSCR loan requirements, every lender is going to vary, but typically the range is a credit score between 620 and 680 plus is recommended. Down payment is commonly about 20%, sometimes more, depending on the type of DSCR loan and the lender. Cash reserves of 3 to 12 months of payments in the bank. This isn't a starter loan for someone with zero reserves. So lenders want to see that you can handle some bumps in vacancy, repairs, or some unexpected expenses. like a new roof or something. Property eligibility. Most DSCR lenders want non-owner occupied properties intended to produce rental income. So these aren't BRRRRs. Common eligibility is single family rentals, duplex, triplex, fourplex, condos, townhomes that allow rentals. Check with the HOAs. Some small multifamily depending on the lender. And some restrictions are properties in major disrepair needing heavy rehabs, non-warrantable condos, properties with unstable or speculative income, and specialty properties or mixed-use properties. And here's a big one. The appraisal often includes a market rent analysis, and that can drive your DSCR. How to get a DSCR loan? Well, here's a simple, clean process. Step 1, confirm the property fits the DSCR guidelines. If it's vacant, recently renovated, or short-term rental, ask how they underwrite their income. Step 2, estimate the DSCR early. Do this before you get deep into the escrow process. And remember, some lenders use market rent from the appraisal, not the current lease rent. So double check those numbers. Step 3, compare lenders and terms. Remember, you're shopping. Pit them against each other. Minimum DSCR requirements and is maximum LTV, fixed versus variable rates, lender fees and closing costs, reserve requirements, prepayment penalty terms, and then property rules like condo, single family rentals, 2 to 4 units. Step 4, gather documents. Even if it's a lighter doc requirement, you'll still need to show your ID, your entity documents if you're buying through an LLC, bank statements and proof of reserves, and a purchase contract or a payoff statement, leases if you've got them, an insurance quote, property details about the property. Step 5 is underwriting the appraisal and final DSCR. Expect an appraisal with a market rent analysis, title and insurance review, verification of down payment and reserves, and the final DSCR based on their methods, not yours. So where to get these types of loans and where these types of lenders are? They're often non-QM lenders. They're private lenders. They're specialized investor lending companies and sometimes banks or credit unions, depending on your market. The key is, though, the underwriting standards vary a lot between these lenders. So don't assume one lender's DSCR rules match another's. So have your paperwork and be prepared. So now how to choose one of these lenders? Here's the lender checklist I would use. First of all, do use your market rent or in-place rents. What expense assumptions do you apply? So what's your minimum DSCR and how does it affect pricing? Sometimes, like I said, 1.0 qualifies, but 1.25 gets way better terms. What's the total cost of the loan, the rate plus the lender fees plus points and closing costs? And then check with prepayment penalties. If yes, how long and what's the penalty structure? Check with your lender, ask questions. Now, the next question I would ask is, do you lend on my exact property type, a condo, a 2 to 4 unit, short-term rental? So ask these lenders directly what their lending types are. And then find out what the typical closing timelines are, because speed does matter in these deals often. So for instance, some common mistakes would be assuming the lender will use current lease rent and not the appraisal market rents. Some lenders use the appraisal market rent only and their own expense assumptions, which can lower the DSCR from what you had calculated. Number 2, underestimating the cash needed. Between the down payment, the reserves, and the closing costs, the DSCR loans often require much more cash than people expect. Mistake number 3, ignoring the prepayment penalty. If you plan to refinance or sell soon, that prepayment penalty can wreck your strategy. So do your numbers and do the calculations. All right, so here's some frequently asked questions. Can the first-time investor use a DSCR loan? Often, yes. Depends on the credit reserves and the property's numbers. What's the minimum DSCR most lenders require? Again, it's about 1.0 to 1.25, but it can vary. Are DSCR loans only for long-term rentals? Not always. Some lenders do short-term rentals, but income documentation and rules can be different. Again, check with your lender. So the bottom line is DSCR loans can be a powerful tool because they focus on property cash flow and not your personal income. But you pay for the flexibility with higher rates, higher fees, a bigger down payment, reserve requirements, and sometimes prepayment penalties. Now, a big disclaimer. I'm not a lender. I'm a California residential broker. I'm not a CPA or an attorney. So this video is for educational purposes only. Underwriting rules, costs that your lender might add, and any advisement that they may have is on them, not on us. So if you liked this video and it was helpful, please comment, subscribe, and share this video. It really helps the channel. All right, I hope this helps. And in the meantime, have a great day, everybody. Talk to you soon.